There are several tax credits that are available to early childhood education businesses. Let's start with the Work Opportunity Tax Credit. Essentially, it's a tax credit designed to offset the wages employers pay to certain groups. Some of these groups include veterans, summer youth employees, and people who have been on long-term government subsidies or unemployed for a long period of time. It can be a really great credit, but it's a little tricky, and obviously, businesses should not discriminate. If we're managing a client's payroll, we automatically attach the pre-screening questionnaire, also known as IRS Form 8850, to every single W-4, I-9 and direct deposit form we send out. If you only give the pre-screening questionnaire to people who you think qualify for it, then you could get sued for discrimination. So it's really important, if you want to take advantage of this tax credit, that you make the pre-screening questionnaire part of your new hire paperwork package. If you do have an employee who qualifies for the Work Opportunity Tax Credit, the next step is to submit the paperwork to the state agency within 28 days of hiring. This timeframe trips up a lot of people. Often clients will come to me at tax time and say they've hired a veteran, but by that point they've missed the window of opportunity. If you manage to submit on time, the state agency will then verify the information you've sent and grant you an approval number. You'll need to use this number on your tax return in order to receive the credit. This is a tax credit a lot of our clients benefit from, and it's definitely something you want to integrate into your new hire paperwork so you can benefit from it as well. Here are some more tax credits for you to be aware of. One is the Employee Retention Credit. This is a tax credit offered to eligible businesses to offset the cost of qualified wages paid to employees during the COVID-19 pandemic. It also includes some health insurance costs. Let's take a look at which businesses qualify for the Employee Retention Credit. Both private sector businesses and tax-exempt organisations are eligible. The business or organisation must have experienced either a full or partial shutdown of operations as a direct result of government mandates pertaining to the pandemic during 2020 or 2021, or at least a 50% decline in gross receipts during a quarter in 2020 compared with the same quarter in 2019. For 2021, gross receipts need to have declined by at least 20% compared to the same quarter in 2019. Most businesses can evaluate their qualification for this credit from March 13th, 2020 through September 30th, 2021. But recovery startup businesses can also qualify for the fourth quarter of 2021. The business is considered a recovery startup business if it opened on or after February 15th, 2020, and its annual gross receipts do not exceed $1 million. Businesses and organisations who qualify can submit retroactive claims for past quarters in 2020 or 2021, but they should be advised that their claims may be significantly delayed due to the current backlog in claims processing through the IRS. Another tax credit is the Family First Credit. Essentially, the IRS pays the wages of any employee who's out sick with COVID-19 or taking care of a family member with the virus for an 80-hour sick leave period. Although both the Employee Retention Credit and Family First Credit ended on September 30th, 2021, you have 3 years from the date your 941 was due to make your claims. So please check to see if your company qualifies for these credits. Then there is a Retirement Plan Startup Costs Tax Credit. With this credit, eligible employers may be able to claim a tax credit of up to $5,000 for 3 years for the ordinary and necessary costs of starting employee pensions, such as a SEP, simple IRA, or qualified plan like a 401k plan. A tax credit reduces the amount of taxes you owe on a dollar-for-dollar basis. The amount of credit is 50% of your eligible retirement plan startup costs. And to really max out this credit, an eligible employer who adds an auto-enrollment feature to their plan can claim a tax credit of $500 per year for a 3-year taxable period, beginning with the first taxable year the employer includes the auto-enrollment feature. The last credit we want to mention is the Small Employer Healthcare Tax Credit. If your average employee wage is less than $56,000, you have between 2 and 25 employees, and you pay for a portion of their health insurance for 2 years, you can get 50% of the amount you paid for their health insurance back on your taxes. If you haven't already taken advantage of these tax credits, definitely bring them up with your CPA.